Hey everybody, it's Daryl with DMD Realty here. Just wanted to go over a program that just came out from Fannie Mae and Freddie Mac. So for all you folks with conventional loan, this has to do with the payment deferral. It's kind of an enhancement, extension, whatever you want to call it, to the forbearance program. But I want to start off again by saying if you can make your mortgage payment, make it. You may choose to not pay other bills. Can't give you advice there, but definitely make your mortgage payment because that's going to affect you the most in big ways. So, especially if for some reason you're not able to pay after the forbearance program's over, you don't want your credit completely wiped out. So anyway, here's some things that you need to know. If you've experienced a financial hardship that's resulted from COVID-19 and it's affected your ability to make your monthly mortgage payment, and say that you've already gotten through that, you're past it, you're back to work, you're no longer on furlough, this is who this is for primarily. So the mortgage loan that you're in must have been current or less than 31 days delinquent as of March 1st of this year. So that was the effective national emergency declaration related to the COVID-19. The other thing is, say that it goes on for 12 months. You must be 31 days or more delinquent, but less than 360 days delinquent as of the date of when they evaluate your loan. So there's going to be a lot to keep up with. They're saying that you're not going to have to provide documentation, but I would urge you provide any documentation, create it, keep it, build a case, document. So what they're going to do according to this is the servicer is going to defer your principal and interest payments along with any advances they pay like escrow, taxes, mortgage insurance, and they're going to put it in a non-interest bearing balance and tack it on to the end of your loan. So here's some eligibility criteria for that payment deferral. We've already talked about it. You must already be on a COVID-19 related forbearance plan, or once again you've experienced a financial hardship from COVID-19 specifically. For example, you've been unemployed, reduced work hours, illness of you, the borrower, or co-borrower, or one of your dependents, and it's impacted your ability to make the full monthly mortgage payment. So they're going to go through, evaluate, and ask some questions. They're going to find out whether your situation is temporary or permanent. They're going to look and see if you've come out of it, are you going to be able to make your mortgage payment. And they're kind of go through other options that may exist for you on workout options if it's appropriate. And they're going to try and get you to commit to work to resolve that delinquency. So that may vary from servicer to servicer. Your servicers are people like Chase, Bank of America, Wells Fargo. You may have your loan originated by someone else, but those are the major mortgage servicers. So that's who you'll be talking with. Okay, so they're going to make sure that you've resolved the situation. And if you have, they're going to make sure that you can continue making that full monthly mortgage payment. And if you can't, if you're unable to, then there may be another route that they can go. There may be what's called the Fannie Flex program. So that's another route that you could possibly take, but that's another video altogether. And they also have specific provisions for Texas home equity loan, because in Texas you have what's called judicial foreclosures for home equity loans. So it's a whole different route, but basically they're going to verify a lot of the same. It can take up to 12 months for you to be foreclosed on if it gets that far. Hopefully it won't. Okay, so once again, the servicer is going to defer up to 12 months of principal and interest payments. Again, any of those escrow expenses mortgage insurance, homeowners insurance, taxes. HOAs are usually paid separately, so that wouldn't be included. So just remember, HOAs can also foreclose on you, so you're going to need to be in contact with them if you're having an issue. They're usually a second lien position, which means that the bank has first lien position, which that means they have priority over foreclosure. So not giving you legal advice, just things to keep in mind. Okay, so here's some, I'm going to flip through my notes here. Okay, so here I mentioned the flex modification. This is say you were not eligible for the COVID-19. This is a route you can take because it wasn't due to COVID-19, something else. They're going to go through, they're going to look and see if you're in a judicial state or non-judicial state. In Texas, we're a non-judicial state except in the case of a home equity loan. So there'll be a bunch of questions they're going to ask and make evaluations. So bottom line is, if you can make your payment, please do so. So here's where I mentioned the servicer has to report the status of your mortgage loan to the credit bureaus according to the Fair Credit Reporting Act. So if you're paying late, again, it's going to be reported late, so that will affect your credit rating. Keep that in mind, especially if you've lost your job. There are some positions, they pull your credit, look at it. If you're in a financial job, that could be an issue for you getting a new position. So again, please make your payment if possible. Okay, now the next thing is they cannot charge you admin fees. They're going to waive all the late charges, stop payment fees, or similar charges once they've determined that you're eligible for the COVID-19 payment deferral. Now, there's another provision, say that you made it through the COVID payment deferral. If you become 60 days late within 6 months after completing that forbearance or deferral, then again, there's the flex mod that the lender may offer. But what you want to keep in mind, it's at their option to extend that. And if you are going to have to short sell, just know that you can be sent a 1099-C. It's what you're short on the mortgage. So say that you bought the home for $350, you had a loan of $300, and now you've missed payments for 12 months, 18 months, whatever it is, and now there's no way for you to pay the mortgage, you're underwater, you can't sell for market value, then you're going to be sent a 1099-C for that difference. So that $25,000 would be taxable as income to you potentially. I'm not a CPA, not a tax professional. There are some provisions that can keep you from having to pay that, but you want to talk to a CPA or tax professional. Anyway, hopefully I didn't ramble too much. I hope this was helpful. I have worked with a lot of folks that needed a short sell, people that were about to be foreclosed on. If you have any questions, I can be of any help or assistance. Don't hesitate to reach out to me. Hope you're having a great day, and I will speak with you soon.